The New Zealand economy appears stable from the outside, but beneath the surface, it is rapidly approaching a critical breaking point. This chart shows real GDP, a metric that measures a country's inflation-adjusted economic output. In the final quarter of 2025, New Zealand achieved a second consecutive quarter of positive growth, hitting exactly 1.0%. But that headline figure paints a misleadingly optimistic picture. Beneath this positive data point, localized risks are compounding. They're combining to create an environment of stagflation, a destructive economic cycle where stagnant growth collides with high inflation. For corporate treasurers and global macro investors, accepting that top-line GDP number at face value means walking blindly into a structural macroeconomic trap. This waterfall chart breaks down the headline GDP number, comparing the 1.0% growth in Q4 to the previous quarter's 3.5%, reveals a massive macroeconomic deceleration. The domestic economic engine is eroding. Personal consumption dropped by 0.4%. Capital investment, the money businesses spend to expand operations and buy physical assets, experienced a 2.1% contraction. Corporate expansion has come to a sudden halt. When private demand and business investment simultaneously contract, the economic engine loses its domestic momentum. This leaves the entire country vulnerable to external global shocks. The first of these external shocks is a drop in export demand. Net exports fell by 1.5%. This bar chart tracks New Zealand's trade deficit. In January, the deficit sat at $340 million. By February, it suffered a sudden blowout. The February deficit reached exactly 850 million New Zealand dollars, highlighting an incredibly rapid deterioration in the balance of trade. The primary catalyst for this drop is China. Beijing is intentionally tolerating a short-term economic slowdown to execute a structural pivot toward technological self-reliance. That specific policy shift in Beijing translates directly into a demand shock for traditional New Zealand commodities, hitting the dairy sector particularly hard. Beijing's policy marks a permanent recalibration of New Zealand's primary export baseline, requiring immediate adaptation from domestic producers. While growth and export numbers plunge, a colliding macroeconomic force is taking hold. Domestic inflation is refusing to yield. This line graph tracks the Consumer Price Index, or CPI, which measures the average change in prices paid by consumers over time. The Q4 CPI rose 3.1% year-on-year, breaching the central bank's mandate of 1 to 3%. The source of this stubborn inflation stems directly from the geopolitical deterioration in the Middle East. This global tension has manifested locally. There is currently a shortage of diesel fuel across New Zealand's vital rural and agricultural sectors. This creates a temporal risk. As the Southern Hemisphere winter approaches, energy supply and demand are projected to hit their absolute tightest bottleneck in May and June. A supply-side energy shock guarantees higher costs will pass through to logistics and agriculture, neutralizing any domestic attempts the government makes to stimulate growth. The Reserve Bank of New Zealand is paralyzed by this divergence, caught between stalling growth and spiking CPI. As a result, the institution is currently in a holding pattern, keeping the policy interest rate unchanged at 2.25%. But on March 24th, Governor Bremen delivered a warning. While temporary energy spikes can sometimes be ignored, rate hikes remain on the table if inflation becomes structurally entrenched. For the April 8th meeting, money markets price a 90% probability the bank holds steady. By the May 27th meeting, markets are split, pricing a 50% chance of a rate hike. The April 21st CPI release is the catalyst forcing the RBNZ's hand. Monetary policy is now entirely reactive. This transforms the New Zealand dollar into a volatile asset, entirely exposed to a single upcoming inflation print. With these clear macroeconomic facts established, corporate treasuries must shift to a proactive defensive strategy for Q2 2026. The first strategic mandate is energy hedging, specifically for agricultural producers, logistics companies, and heavy industrials. Treasurers must immediately audit supply chain contracts and lock in fuel costs. Do not assume the government's supply diversification efforts will successfully cap spot prices in the short term. The second mandate is executing a China Plus One export pivot. Exporters must divert marketing and sales capital toward India, Southeast Asia, and the Middle East to offset the shrinking baseline of Chinese demand. Surviving Q2 requires abandoning passive procurement. CFOs must rely on an aggressive, geographically diversified operational defense. Beyond operations, the Reserve Bank's policy gamble presents a direct threat to corporate balance sheets. Multinational firms must prepare for elevated foreign exchange friction and volatility in the New Zealand dollar to US dollar cross, leading into the April 21st data release. This diagram illustrates a structural hedge for this environment, transitioning cross-border business-to-business settlement to USD-backed stablecoins. A stablecoin is a digital cryptocurrency strictly pegged to a stable asset, like the US dollar. Utilizing this digital settlement architecture locks in global liquidity, preventing working capital from being affected by localized central bank rate shocks. In a localized stagflationary trap, adopting decentralized settlement tools transitions a corporate treasury from being affected by macro volatility into an insulated operator. New Zealand's economy is squeezed between plunging domestic and export growth and a winter energy shortage. The Costa Central Bank is paralyzed by this divergence. Proactive corporate defensive hedging is the only viable strategy moving into Q2. Will the Reserve Bank be forced to hike rates into a slowing economy to fight the energy shock, or will they hold steady? Let us know your macro outlook in the comments below.